There's a common phrase that I like to keep in mind as a dividend and a value-focused investor. It's that the market is often wrong, but it is never stupid. What do I mean by that? Well, first of all, I often believe that the market is wrong because I do not subscribe to the efficient market hypothesis in that at all times, all stocks have all possible information fully priced in, and therefore it's impossible to beat the market by picking individual stocks. And therefore, you should just invest in low-cost, well-diversified ETF and let time run its course. Now, I think that's a very reasonable approach. You're going to get average returns by definition, or at least close to it, depending on the exact ETF you pick and what time you buy in, etc. But I think that's a fine approach. In fact, I think that is the approach that the vast majority of investors should take. If you're not willing to take your own time and invest in researching stocks, or at the very least, pay some money to a research expert to help you with your own research to help, grease the wheels for you, so to speak, so you can make intelligent picks. If you're not making intelligent fundamentals and value-driven choices of what stocks you're going to buy, and you don't have the temperament to withstand short-term volatility, to be patient, to know when to buy, to know when to sell, to know how to diversify. If you don't know how to do all that, or you're not willing to pay someone that you know and trust to do that for you, then yes, I think index funds are a fine way to go. But I do believe that there are inefficiencies, and my own experiences has proven it. I've invested in the market for well over 10 years, actually close to 15 years now, and I've been able to beat the S&P 500 quite substantially over that period of time. It's not like I invested in Bitcoin or Nvidia or anything like that. In fact, I never have invested in either of those. I've invested almost exclusively in high-yielding dividend stocks that have actually underperformed the S&P by a good amount as a sector over that period. But because I've used an intelligent, value and fundamental focused strategy with opportunistic capital recycling like I use at High Yield Investor, where I run an investment group on Seeking Alpha, I've been able to beat the market over that period of time. But that being said, I've also learned that the market is not stupid. In other words, it doesn't give away free gifts. What I mean by that is if a stock is trading at what seems to be a steep discount, or especially a high dividend yield, there's usually a good reason. In fact, there's always a good reason for it. Now, the market may be mistaken in its reason, but there is some compelling evidence, a reasonable argument to support the market's decision, so to speak, collective decision to price an asset the way it is. And so you should always take that into careful consideration when buying a stock. It's not simple as, oh, I'll just buy all the high yield stocks and hope that in aggregate they outperform. No, you have to intelligently pick and choose which ones you buy and which ones you don't. And so in today's video, I'm going to show you an example of this by looking at roughly 14% yielding investment opportunities right now. One that I think is actually underrated and is mispriced and worth buying, and one that I think is actually overrated by Mr. Market and is not worth buying right now despite the compelling yield. Before I get into these individual stocks though, again, if you could please like this video, I would greatly appreciate it. It really help me with its distribution, help me grow my channel. Thank you so much. Okay, so which one of these would I sell? Which one do I think is overrated? Well, it's actually a closed-end fund by PIMCO. It's ticker symbol PDI. Now, it has a lot of popularity with investors because it actually does have a pretty good track record. Again, that dividend is really nice. It pays out monthly. It's been able to sustain it over time. It's generated pretty decent long-term returns. So again, my issue with them is not the management. I think the fund management is fine. My issue with the fund is simply this. It uses too much leverage. It has about 35% leverage right now. And again, when used in a CEF like that, it's often margin leverage, which means that in a rapid market drawdown, they may have to face a margin call or sell off some of their assets at the lows in order to pay off some of their debt to keep their leverage ratio within covenants. And what that means is that they are very risky. They are ticking time bomb basically for the next crash, potentially. Again, depends on exactly how the market plays out, but you're taking an elevated risk with that sort of leverage. I also think their management fees are quite high. Now, again, they've justified the management fee so far because they have good returns and they've done a pretty good job of paying out their dividend consistently. So again, my huge issue is not the management fee, but that is a strike against them. My other big issues with them are, one, they trade at a massive premium to their net asset value. In fact, higher than they normally do. And I agree. Again, their track record is pretty decent. I don't have an issue with them trading at a premium to their net asset value per se, but they have a high premium to their net asset value. And when you combine that with, this is the other point, they invest primarily in very low grade, junk debt effectively. And so that means if we end up going to any kind of economic downturn, where a lot of these loans get distressed, maybe go into default, or at the very least need to be reworked, that's going to cause their net asset value to drop. And that's going to cause, if you look at history and during past crashes, their price to NAV or their premium is going to evaporate. In fact, may fall all the way to a steep negative. And so that's going to, when combined with the leverage, that's going to create an explosive effect at destroying shareholder value, because not only is the NAV going to drop and likely the price, at least in line with the decline in NAV, but historically the valuation multiple is also going to decline. And then on top of that, the leverage that they use will cause their net asset value to decline even faster. And so you have a threefold effect that could cause the share price to have, or even worse, in a very short period of time if we start to see some major cracks form in the economy and in their loan book. And so while the yield looks nice, they have a decent track record, I see PDI as a ticking time bomb. Meanwhile, if all goes well for the economy, sure, they may continue to pay out their dividend, and yes, that will be a satisfactory return. Very nice. But I don't see any valuation multiple expansion potential in their future. In fact, I see it likely declining some. I don't see much growth in NAV for them in the future either, given that they pay out pretty much all of it as dividends, if not more than what they actually generate in internally generated cash flow, depending on the moment and how their portfolio is constituted. And so, again, the upside potential here is at best slight market outperformance of at least market average returns over time. But worst case scenario is a complete evisceration of shareholder value. And so, again, the risk reward there is just not attractive to me. And so for those reasons, to quote from Shark Tank, I'm out. Okay, now before I get into the second one, the one that I would buy that yields about 14% right now, if you could please subscribe to my channel, I greatly appreciate it. I'm nearing 4,000 subscribers, and it'd mean a lot to me if I could get there soon. So thank you so much. Okay, so what is the one I would buy? Okay, it's FSKKR. It's a business development company. They have an investment grade credit rating. They are managed by one of the top alternative asset managers in the world, KKR Credit, which is the credit arm of KKR, one of the largest alternative asset managers in the world. And they have a pretty good track record of doing a good job with underwriting in their funds. And so even some of these investments that they have in their funds for institutional clients, FSK gets to invest in those. Now, FSK had a previous manager that was not good at all. And since KKR has taken over the management of the fund, they've been gradually cycling out of the legacy portfolio and into their own proprietary investments. And if one of the big headwinds for FSK so far has been it's had a bit of an elevated non-accrual rate on its investments. But if you look at just the KKR underwritten loans, their non-accrual rate is way lower than the legacy portfolios. In fact, if you just look at the KKR portfolio, which is about 90% of the total portfolio, their non-accrual rate is quite low. It's pretty much in line with some of the better BDCs out there. Meanwhile, the market has penalized FSK for this by giving them a large double-digit discount to their net asset value at a time when a lot of their peers who have similar fee structures, etc., are trading at, like, for example, Aris Capital Corporation, trading at meaningful premiums to their net asset value. And so there seems to be a big market disconnect here where it's being unfairly punished for just 10% of its portfolio that has some legacy issues, but still is generating some value for shareholders. And because of this huge discount, investors can now buy shares of FSK. When you include their special dividends that they've been paying out because they're generating so much earnings, their yield is about 14 or close to 14%. You get that big discount to net asset value. And yes, they have some leverage, but it's not particularly high. It's pretty average for a BDC. And so, again, if you look at this on a risk-reward basis, what is the worst-case scenario? Okay, yes, a worst-case scenario is not good for FSK either because they do invest in some riskier middle-market loans. And so I do expect in a recession that they're going to see an uptick in their non-accruals and defaults. I expect that, the stock price will drop with their net asset value when that happens. But the one thing with FSK versus PDI is that it trades at a meaningful discount to its net asset value today, whereas PDI trades at a premium. And so I do not think that the price to NAV ratio is going to shrink that much for FSK in such a scenario. And so its downside potential is not nearly as bad as PDI's is. Meanwhile, if things continue to just hum along or even improve for the economy, I think FSK is going to continue to improve its underwriting performance with KKR's help. And so I think that their price to NAV gap is actually going to close. So in addition to that nice dividend that you get with both PDI and FSK, you also get a valuation multiple expansion with FSK, which will help deliver even higher total returns. And that shifts the calculus of the risk reward, both the lower downside risk as well as the higher upside risk for FSK relative to PDI. It makes me think that FSK is actually worth buying today. So again, hopefully this video is helpful for you. Hopefully it gives you a little bit of insight into how to evaluate these really high yielding stocks that you shouldn't necessarily just completely avoid them, but you also shouldn't necessarily just buy them blindly. Know how to look at them and determine the risk reward. Regardless, FSK is not a low risk investment either because of that yield, because it invests in some riskier loans. It does have some leverage. It has had some issues in the past from its previous manager in terms of underwriting and still has 10% of its portfolio in those loans. So again, it's not risk-free. I just think the risk reward is favorable there, and it's worth buying if you're comfortable with that little bit of extra risk. So again, hopefully this video was helpful to you. If it was, please subscribe to my channel. Help me get to 4,000 subscribers. I greatly appreciate it. Thank you so much. Have a great day.